So today, we're going to dive into one of the most talked about ideas in investing, Ray Dalio's all-weather portfolio. This is a strategy that's not about trying to outsmart the market. Nope, it's designed to be tough, to be resilient, no matter what the world throws at it. Let's get right into it.
But first, let me ask you something. You've been told to diversify, right? And you probably think you have a nicely diversified portfolio. But what if that's just an illusion? What if the very thing you think is safe is actually a ticking time bomb, just waiting for the right or maybe the wrong moment to go off?
To really get why, we need to pull back the curtain on the most common strategy out there, the good old 60-40 portfolio. I mean, it's the foundation of retirement planning for millions of people, but it's got a secret, and it's a pretty big one.
So, on the surface, this thing looks perfectly balanced. You put your money, your capital, into two buckets, 60% in stocks for that nice growth, and 40% in bonds for safety. It's simple, it's logical, it's diversified, right?
Well, wrong. And this is the part that blows most people's minds. See, while you split your dollars 60-40, you didn't split your risk that way. Not even close. Because stocks are just so much more volatile, so much riskier than bonds. They actually account for something like 90% of your portfolio's total risk. Your balanced portfolio? It's not balanced at all. It's basically a giant bet on the stock market.
So here's the bottom line. Whether stocks go up or down, that's where your entire portfolio is going. Those bonds are kind of just along for the ride. This isn't real diversification, and it leaves you incredibly exposed to just one thing happening, the stock market going up and only up.
You know, this exact problem is what sent Ray Dalio, the founder of the massive hedge fund Bridgewater Associates, on this quest to build something that could actually stand up to anything. He wanted a portfolio that could truly weather any economic storm.
Now, the story starts way back in 1975, but the big breakthrough, the real game changer, happened in 1996. Dalio had a personal problem to solve. He needed to set up a trust fund for his family that would last for generations. He needed something that would do well no matter what the economy looked like. And that personal mission is what led to the all-weather fund and a totally new way of thinking about how to invest.
And the core idea, the big aha moment that just changed everything, was this. Stop focusing on balancing your dollars and start focusing on balancing your risks.
Dalio figured out that what really moves asset prices are surprises in two big things: economic growth and inflation. This basically creates four possible economic seasons. Stocks do great when growth is higher than anyone expected. Bonds do well when growth is lower than expected. And things like commodities and gold, they have their moment when inflation pops up unexpectedly. So the question became, instead of trying to predict the weather, why not just own a portfolio that's ready for any season?
And this brings us to the central concept, risk parity. It's a really simple idea, but it's also profound. Instead of splitting your money 60-40, you build a portfolio so that the risk coming from stocks and the risk from bonds and the risk from everything else, they each contribute an equal amount to the portfolio's total risk.
So let's just put this side by side. It makes it super clear. On the left, you've got the old way, capital allocation, which we now know actually concentrates all your risk in one place. And on the right, you have risk parity, which divides the risk itself, creating a truly balanced portfolio.
Okay, so that's the theory. But what does one of these things actually look like? How would you even go about building it?
Dalio actually shared a simplified recipe for the all-weather portfolio once. And when you look at it, you probably notice a few things. First, only 30% is in stocks. A way bigger slice, 55% total, is in different kinds of bonds. And that's because bonds are way less volatile, so you need to own more of them to balance out the massive risk that comes from the stocks. Then, you've got these equal slices of gold and commodities to protect you if inflation gets ugly.
And what's really cool is that you can actually build something like this yourself using really common, cheap ETFs. You could use something like VTI for stocks, TLT for long-term bonds, GLD for gold. You get the idea. Now, I have to say this loud and clear. This is just for illustration, okay? This is not investment advice, but it does show you how accessible this kind of strategy has become.
But here's the billion-dollar question, right? Does it actually work? Well, let's look at the performance. And honestly, it's like that classic story of the tortoise and the hare.
So think back to the 2008 financial crisis. It was a total bloodbath. The hare, the S&P 500, just got obliterated, falling over 50%. The all-weather, our tortoise, it fell too, but by less than half as much. This is its superpower. It protects your money when everything is hitting the fan. Stability when there's chaos. But, and this is a huge but, there's a trade-off. When the market is roaring, when we're in a big bull run, the hare just sprints ahead. The stock market is going to give you much higher returns, And the all-weather's slow and steady approach is definitely going to lag behind. It's not designed to win the sprints, it's designed to finish the marathon.
And that brings us to the final and maybe the toughest part of this whole thing. It's not the markets, it's not the math, it's you. It's your own brain.
I mean, think about it. The strategy works. It's resilient. It makes a ton of sense. So, what's the catch? Why isn't everybody doing this?
This quote just nails the problem perfectly. The portfolio is designed to always have something working well while something else isn't. It's built to be, well, kind of boringly consistent. And in a world of hype and FOMO, that consistency can feel like absolute torture.
This feeling actually has a name. It's called diversification regret, and we've all felt it. It's that gnawing feeling you get when your neighbor's tech stocks have doubled and your commodities are just sitting there flat. It's that constant temptation to just junk the plan and chase whatever's hot. Sticking with a balanced portfolio when some other asset is going to the moon is incredibly hard to do.
And that's really what it all comes down to. The all-weather philosophy really forces you to answer a huge question about your own investing. Are you building a portfolio for the world you hope for? The one where stocks only go up? Or are you building a portfolio for the world as it actually is? The one that's fundamentally and forever completely unpredictable? That's the choice.